The global monetary system is a sprawling, intricate network deeply rooted in the aftermath of World War II and shaped by decisions like the Bretton Woods Agreement. Yet, beneath this intricate web lies a fragile foundation that grows increasingly unsustainable. The structure, once stable and gold-backed, now teeters on the edge of collapse, propped up by an ever-growing debt burden. To understand the looming economic transformation, one must delve into international trade's reliance on the dollar, the hollow pyramid analogy of the monetary system, and the critical role of gold and silver as the only viable alternatives to fiat currency. At the heart of global trade lies the US dollar, a currency that has dominated international settlements for decades. Despite recent headlines proclaiming attempts by countries like China and Brazil to bypass the dollar by using their own currencies, these efforts remain tethered to the dollar in a fundamental way. Imagine a scenario where China and Brazil strike a deal to use the yuan for oil trade. On the surface, it appears to circumvent the dollar. However, in reality, the yuan is merely a tool for settling a trade that is still fundamentally dollar-denominated. The structure of international trade has been constructed around the dollar, ensuring that even deals seemingly outside its reach are indirectly connected to it. This is because the global trade network operates as a hierarchical system. At its core is the dollar, a remnant of the post-Bretton Woods era when the US dollar was directly redeemable for gold. Countries were encouraged to hold dollars instead of gold, trusting in the promise of its stability. And even as the gold standard was abandoned, the dollar retained its primacy, becoming the base currency upon which all other transactions rest. The dollar's role as the anchor of international trade ensures that alternatives remain superficial until the system itself changes. To visualize the global monetary system, one can imagine a pyramid. At the time of the Bretton Woods Agreement, this pyramid was filled with gold, solidifying its base and lending credibility to the system. Gold backing ensured that the dollar and, by extension, other currencies held intrinsic value. However, when President Nixon ended the gold standard in 1971, the pyramid was hollowed out. Gold, once the bedrock of global currency, was removed, leaving the dollar as the sole foundation. This shift fundamentally altered the monetary system, creating a fragile structure that appears stable but is fundamentally empty. The hollow pyramid analogy underscores a key point: the entire system now depends on the perceived value of the dollar, not on tangible assets. To operate outside this structure, countries would need to abandon the pyramid entirely and revert to trading directly in gold or silver. But this requires a monumental shift, one that nations are unwilling or unable to make unless forced by catastrophic events such as a collapse of the dollar itself. If the hollow pyramid represents the fragility of the current system, then gold and silver symbolize its potential replacements. True independence from the dollar cannot be achieved by superficial measures, such as trading in alternative currencies that are still dollar-referenced. Instead, nations must move to a system where transactions are denominated in ounces of gold or silver, completely bypassing the dollar. For instance, if two countries agreed to trade goods based on a weight of gold or silver, the dollar would play no role in the transaction. However, such a shift requires abandoning the mindset of equating everything to dollar values. A deal denominated in gold worth $100 million is still a dollar trade. Only when transactions are defined in terms of ounces detached from fiat currencies does true independence emerge. Yet, this shift will not occur voluntarily. It will require extreme conditions such as the collapse of the dollar on the global stage. Until then, the inertia of the existing system will keep nations within the confines of the hollow pyramid. One of the most glaring weaknesses of the current monetary structure is its reliance on debt. Debt has become both the engine and the burden of the global economy, creating a feedback loop that grows exponentially. To sustain the system, new debt must continually be created to service existing obligations. This phenomenon is akin to climbing a ladder that extends endlessly upwards as debt grows, so does the need for more borrowing. This dynamic ensures that the system remains stable only as long as confidence in the dollar persists. However, this feedback loop has an inherent breaking point. As debt levels soar, the burden becomes unsustainable. A single financial crisis could force central banks, like the US Federal Reserve, to print unprecedented amounts of money to stabilize the system. The sheer scale of such monetary expansion would bring the hollow pyramid closer to collapse. A crisis driven by rising consumer prices, combined with central banks cutting interest rates and printing more money, could set the stage for hyperinflation. This scenario represents the tipping point where the public begins to lose faith in fiat currency, realizing that their savings are eroding rapidly. Hyperinflation is not merely an academic concept. It has occurred throughout history, from the German Weimar Republic to Zimbabwe and Venezuela. When confidence in the currency evaporates, people seek refuge in tangible assets like gold, silver, and real goods. In such a crisis, gold and silver become the ultimate safe havens. Unlike fiat currencies, they are immune to devaluation by central bank policies. As individuals and institutions scramble to protect their wealth, demand for these assets skyrockets, driving their value higher. The current monetary system is unsustainable, heading inexorably toward collapse. The hollow pyramid propped up by debt and confidence cannot endure indefinitely. When the tipping point arrives, the transition to tangible assets like gold and silver will be swift and decisive. This collapse will not occur in a gradual, orderly fashion. Instead, it will be marked by a sudden and chaotic shift as individuals, corporations, and nations abandon fiat currencies en masse. The resulting economic upheaval will force a revaluation of the global monetary system, paving the way for a return to tangible asset-backed currencies. Personal anecdotes highlighting monetary instability. The instability of fiat currencies is not merely theoretical, it is a lived experience for many. Personal stories often reveal the human cost of hyperinflation and the fragility of fiat systems. One such story involves the old shekel in Israel, which hyperinflated to the point of worthlessness. A child discovering a 1,000 shekel bill might initially marvel at its apparent value, only to learn that it has no purchasing power. Such experiences underscore the disconnect between nominal values and real worth in a fiat system. Another example comes from high school economics classes, where students are taught about the shift from gold back to fiat currencies. The idea that a currency has value simply because a government decrees it so can be profoundly unsettling. This realization often leads to a deeper questioning of the monetary system and its sustainability. The global monetary system, dominated by the dollar and supported by a fragile pyramid of debt, is rapidly approaching a breaking point. While countries attempt to bypass the dollar, true independence requires a complete departure from the existing structure, embracing gold and silver as the foundation of trade. As debt continues to grow exponentially, the risk of hyperinflation looms ever larger. When the system collapses, the transition to tangible assets will be swift, reshaping the global economy. For those who recognize the signs early, preparing for this shift by investing in gold, silver, and other tangible assets is not just prudent, it is essential. The lessons of history and personal anecdotes serve as stark reminders of the fragility of fiat currencies. The hollow pyramid, once propped up by confidence and debt, will inevitably crumble, making way for a new monetary order grounded in real value.